and welcome to Next Generation Finance, a new podcast from SEB where we explore the world of sustainable finance, its present, forecasts for the future, and the recent developments in the market. My name is Lina Apsheva. I'm a sustainable finance analyst at SEB, and today I am joined by Christa Clapp, the head of climate finance at Cicero, who is joining us over the phone from Oslo. Hi, Christa. Thanks for joining us.
Good morning. Thanks for having me.
And we're also joined by my colleague and advisor within sustainable finance here at SEB, Gregor Vulturius.
Hi, thanks for having me.
Before we move on with this discussion, could you maybe just remind our listeners what sustainable finance is and what we mean when we talk about sustainable financing in this context?
So sustainable finance is any type of investment where you take into consideration, of course, a profit that you want to generate, but also the impact it has on people and on the planet.
For anyone who would like to know more about this question, please feel free to listen to our first episode where we discuss in detail the history of the sustainable finance market. So today we'll be talking about the sixth assessment report of the IPCC, the Intergovernmental Panel on Climate Change. And in particular, we talk about the first working group report, which was published last month under the title Climate Change 2021, the Physical Science Basis. But we'll also talk about the upcoming reports of the second and especially the third working group, where Christa is one of the authors. And with the help of Gregor, we'll also dive into what the report and the things that are highlighted in it mean for the finance industry and for business. But before we dive into the discussion on IPCC, Christa, could you give us a brief introduction into your work at Cicero and also maybe for our listeners who are not so familiar, what Cicero is as a company and organization and what you do there?
Yes, of course. So Cicero is a nonprofit climate change research organization based in Oslo, and I am leading the climate finance research stream there. And as part of my responsibilities, I am also a lead author on the Working Group 3 on mitigation of the next IPCC report that will hopefully be coming out next spring. But I also have another hat where I sit also in the commercial arm of Cicero, which is called Cicero Shades of Green, and provides applied climate research to investors in the form of green ratings and second opinions for bonds, as well as for green equity.
Christa, you just mentioned on what you do at Cicero Shades of Green. Could you maybe explain a little bit more what you do when you work on equity?
Of course, yes. We've taken our Shades of Green methodology, where we assign light, medium, or dark green as an indicator also of climate risk on the bond side, and we have applied it at a company level that can service equity markets. So what we do is we take the revenue streams of a company, and then we go through and we parse it out into our shades of green, which can sometimes be not so green as well. We've expanded our shades of green to also include yellow and red, and kind of a traffic light signal about things that are positive for the climate to invest in or not. So fossil fuel new investments would be on the red side, obviously, and then on the other end of the scale is the dark green that's targeting the Paris Agreement targets at zero emissions mid-century. So we have that whole spectrum that we apply to the revenues of a company that gives a snapshot of where they are today. And then we also apply it to their investment streams. And we think it's important to have that forward-looking element because if you just look at, for example, a carbon footprint of a company today, it doesn't tell you the story of how that's changing over time. They may be implementing some activities or programs or policies that you may see in a couple of years come out on back in their revenue streams, but you see it on the investment side now. This is a product that has been used for green IPOs, for example. It's been used also for companies that want to begin to prepare either for taxonomy alignment or TCFD reporting. And it's also being used as a check for alignment against the NASDAQ green designations for equity. And that we help them, along with others, provide input into what their designation requirements are.
So let's talk about the IPCC 6th assessment report then. What is it?
Well, I think we should start with what the IPCC is, because this is an important thing to understand the context of the report with. It is a collection of scientists and authors from around the world with representation from, I think, more than 170 countries, depending on which working group you're looking at. And the process is a multi-year process to assess the latest scientific literature from around the world. And so this collection of authors works together for a number of years, and they produce a rather lengthy report on the latest in the science. It's split into 3 working groups. The first is on the physical science, the second is on impacts, and the third on mitigation, and that's the one that I'm a part of. And then there's a rather special process that the summary for policymakers goes through for each of these 3 reports. It goes through a vetting process by all of the contributing countries to the IPCC. So they sit and actually negotiate line by line to make sure that everyone is comfortable with the wording that goes out to the world. And that is because it has such an influence on the direction of climate negotiations and policy making. So the country negotiators do not have any influence over the writing of the report. And then the summary for policymakers has to reflect the science, and every line has to be based in the science. But then they can approve of the final wording and fine-tune that and make sure the messages are very clear and targeted.
So the report of the first working group was published last month, and it made quite a lot of noise in the press worldwide. Could you give us maybe a brief insight into what does that report highlight? What does it talk about?
Yes, the report highlights, I'm afraid there's not really a lot of good news in the report. It highlights that the recent climate changes are both widespread and intensifying, and that they're being felt in all regions of the world. And part of this is shown by extreme weather events such as heat extremes, drought, and heavy precipitation. And they're seen in varying degrees and to varying levels of extremity in different regions. But there is nowhere that's really safe from these changes. And the other thing that's very clear in this report is that it's indisputable that humans have caused this. So there's been some advancements in the attribution science that make it unequivocal that this is the world that we have created by emitting greenhouse gases. One of the more balanced points is that we have emitted already enough greenhouse gases in the atmosphere that we're experiencing on average a 1.1 degree warming already in our world. And that's why we're seeing some of these extremes in the weather patterns. It is possible to turn back from where we're headed on the scale of climate change and global warming, but we've already locked in for the next 20 years approximately 1.5 degree warming. And the Paris Agreement, that's the international climate agreement that approximately 200 countries have signed on to, it aims to limit global warming on average by the end of the century to 2 degrees or lower. And so we do have, a very, very limited amount of room to turn back what we're emitting in the atmosphere, but it requires, very widespread and very urgent reductions in the emissions that we're making in most sectors of the economy.
And who would you say is the target audience for the report? Do you understand correctly that it's mainly policymakers? And if that's the case, does it mean that the publishing of the report will have some implications on kind of the way the world works?
Well, the summary for policymakers that came out of the report is absolutely geared towards policymakers. However, it stops short of being policy prescriptive, and that is a real defining element of the IPCC assessment report. It assesses the science and it represents the latest science, but it doesn't necessarily tell policymakers what to do. But hopefully it's providing the context to support them in their decision making. So yes, it is aimed at policymakers, but it is, it's seen as sort of a background report heading into the next conference of the parties for the climate negotiations this year. And then it's up to to individual governments to hopefully tighten up their emission targets underneath the agreement, and then come back home and implement that into national policy. So there is a rather long trail from reading the IPCC report, getting that woven into decisions, and then getting those decisions implemented to reduce greenhouse gas emissions.
I see. And Gregor, what do you think that means for us as bankers and for the finance industry at large?
Well, I believe it has very strong implications for us. I think that we need to understand that this report really gives us the data that is required to assess to what extent, our loans and our customers, our balance sheet is exposed to, the physical risk of climate change. So what Chris already mentioned, the kind of droughts and heat waves and sea level rise that we are, can anticipate and expect in the future, but also to understand the transition risks, or the risks that are, born out of, rapidly reducing emissions and policy actions to that effect. So this is really something that, the finance industry is increasingly understanding and addressing. We do this here at SEB internally in assessing our customers and our loan sheets, but it's also something that regulators are really forcing us to do. Here in Europe, we have the ECB that are orchestrating right now a climate stress test for the entire industry, the entire banking industry. And then there's the EU taxonomy, of course, that also helps us to better understand where to channel money to and where the needs are to, achieve the Paris Agreement and limit warming to 2 degrees.
So, Gregor, you mentioned transition risks. What exactly do you mean when you talk about transition?
Well, yeah, I mean, we guess that around 90% of companies today are not dark green, or they're not entirely green. So they will, be impacted by policies and customer demand asking them to decarbonize. And that's the kind of risk that we're meaning. And, it could be from renewable energy, it could be new regulation that is putting a dent on companies' balance sheets, basically.
And Christa, at Cicero Shades of Green especially, you work quite closely with investors and companies that are issuing bonds and perhaps other financial products. So would you say that the findings of the report will affect your work at Cicero, or how do you kind of assess it when it comes to working with those companies and financial stakeholders?
Yes, the IPCC report absolutely feeds into our work. But interestingly, the assessment report, the 5th assessment report, came out in 2013 for Working Group 1. So quite a bit of time has passed. But honestly, the direction of the messages is not very different. So it doesn't dramatically change our approach, but of course it's updated. And with the new report, we have a lot more granular information at the regional level about extremes, and of course updated on observed events already that have happened in the past few years. And there's also, of course, improvements in attribution science and in assigning different events to actually the impacts of climate change and looking at the counterfactual, what would have happened without climate change. So there's certainly improvements and updates in the science that are represented in the report, but it does the conclusions that come out of the report should come as no surprise to anyone working on in climate change research, for example. So the way that we use this in our Shades of Green approach to rate green bonds and also to assess company revenue streams and investment streams is by using our dark green shade, that's our highest level rating, to indicate that this is an activity or an asset that is in general alignment with the Paris Agreement target. That is to say, it's aiming at close to zero emissions in mid-century for each sector. And that's something that the report can inform, and also building in resiliency to all of the built-in environment and across all those sectors, all the infrastructure decision. So it's something that is absolutely informed by IPCC, but it hasn't, those messages have not changed in the direction and the trends that they are in a few years. It's just more detailed, more nuanced, and updated information.
I see, and that's of course not surprising considering that you have been working in the sustainability and the sustainability finance field for many years as a company and organization. But what I'm curious about is, and I guess this is a question to both of you, do you think the report and perhaps the amount of attention that it got in the media and just in the public will affect the way that investors view the ways they invest?
Well, I hope so. I think what's new about this report is actually the timing. So if you're paying attention to the news and the events, even over the past summer, we've seen extreme weather events linked to climate change in a number of regions, including here in Europe, with flooding in Central Europe that was really devastating. And the timing of this report comes on top of what we're reading in the newspaper every day. And I think that is why people are paying more attention to it now. So I really hope it has a signaling effect for companies and those in the financial sector as well to understand this is the urgency and the seriousness of the problem. But again, it comes down to these the policy implementation by national and regional governments, and then ultimately into corporate decision making, into what are their policies and what are their targets at a corporate level in order to make sure that they are also aligned with strong action on climate change.
Yeah, I believe that, the timing was mentioned before. AR5, the last assessment report came out, 7-8 years ago. And we are fundamentally in a different world right now, at least when it comes to finance. There is a lot more of the infrastructure for sustainable finance in place. The green bond market and the sustainable bond market is now firmly established. Principles out there with the principles for responsible investing. We have just recently, SAB signed up for the Net Zero Banking Alliance. So you have a greater awareness, and I would say also more touching points between the science and the finance world that makes it more likely that the industry will take this report more serious, or even more serious than before. And more importantly, that the industry is also reallocating capital, because that's of course the challenge you have right now is that the amount of the gap between what we're currently investing in renewable energies and climate mitigation and even adaptation, is in an order of 4 or 5 times magnitude smaller than we need to limit global warming. So there's great awareness, but the challenge has probably increased since last report, unfortunately, because emission has continued to rise.
And I see how investors and just people in finance in general who work directly with sustainable investments or responsible investments might be kind of in the loop when it comes to this discussion. But I'm curious, when it comes to the quote-unquote regular bank worker, for example, someone who works with finance but maybe not with sustainability directly, do you think this is something that they should be paying attention to? And if so, then why?
Absolutely. I think that's one of the biggest takeaways when we think about the impacts of climate change that we're facing now and will continue to face at the same level or worsening over the next 20 years because of emissions we've already sent into the atmosphere, is that we can't ignore these climate impacts, and we can't ignore the urgency of the needs on the mitigation side. So I would encourage everyone to read the Summary for Policymakers. It has some very nice graphics in there and some nice supplementary information to just understand the context. I think there's so much capacity building that needs to happen within companies, and particularly in the financial sector right now, with all the attention on climate risk disclosure and changing regulations, for everyone to be up to speed and to understand what are the implications, and then think through and work with decision makers in your bank or in your company to understand how are we taking this information into account.
Yeah, and just to add on what Christa just said, I think that depending on where you are in the finance industry, the touching point with climate risk and sustainability issues, it's for you to find out. But just to give a few examples, I mean, if you're working with, as a client executive with big industrial companies in Europe or North America, I mean, you will be exposed to regulation and a carbon price that are increasing. So you need to be aware of what this report is saying for you to understand how prices might change and regulations might change. The same also goes for those working with retail customers. We've seen an enormous increase in demand for ESG investing, so sustainable types of investing when it comes to pensions or green mortgages. And those are the same drivers, I think, at large that function here, and that should give you who work in this industry, greater motivation to really get up to speed.
So, Christa, I know that you can't talk about it too much, but I was still wondering if you could give us a little bit of insight into what we can expect from the IPCC reports in the future. I know that the Working Group 3 report is coming out in March, hopefully. So what can we expect?
Sure, I can only talk at a general level, as you know, but the Working Group 3 on mitigation, where I'm a lead author on the finance and investment chapter, we'll have a lot more information on mitigation, for example, cost and potential by sector. And then finance is one of these cross-cutting topics that goes across the different sectors, where we will be looking at the latest and assessing the latest literature on what are the flows of finance, both public and private sources and mixed sources, going towards climate action, on mitigation and on adaptation. how does that compare to the rather great needs we have for investing? And then what are some of the updates and impacts of those updates in the capital market changes and the regulatory changes? And then, of course, I think a theme across the whole working group is actually what are the opportunities that a COVID response can offer, or what are the challenges embedded in there, and how does that link with climate action?
And what kind of investment mechanisms would we need to kind of see in the response to both the pandemic and also the climate crisis?
Well, there's a lot of opportunities now, especially in some of the newer products coming out, newer labeled products for social sustainability and sustainability-linked bonds and loans, where a recovery package can be well combined with sustainability and green goals. And there shouldn't be any reason to lock in new infrastructure projects that aren't also accounting for sustainability and planning for resilience to the climate impacts that are apparent from the Working Group 1 report.
Before we wrap up, I also wanted to ask you maybe a little bit more of a personal question and kind of stepping out of the IPCC discussion. If you could just give a piece of advice to anyone working in finance or in business.
Well, I would say that actually, working in climate science, it can be a rather depressing field. But this one area for optimism is actually the rapid change that's going on in the financial sector. So the financial sector alone can't solve the climate problem. We also need very strong climate mitigation policy and resiliency planning tools and regulations. But this momentum in the new product space, in the regulatory space, in the finance sector is quite incredible. And all the advertisements for hiring for sustainable finance experts within banks and other financial institutions, I think it's an incredible, sustainable finance wave here. New programs at the master level and bachelor's level even. It's incredibly encouraging. And so I don't know if it's advice, but I just think there's such an opportunity to grasp here to train up and learn more about climate change and the climate risk, be prepared for the new regulations, and take advantage of some of these new financial products that are coming on board. And I think this can help support solving the climate crisis.
Thank you so much, Christa. And Gregor?
I think for me personally, it's understanding that we are here to contribute to building a world with less pollution, with hopefully greater equality. Hopefully we get there in time, but that doesn't mean that we shouldn't, give up hope. And I think that's maybe the last thing that I want to give anyone. Was the IPCC report certainly can be quite disheartening to read, and we should always remember that what we're trying to do is to really re-engineer how we have created, prosperity and livelihoods, and that is quite a challenging but also quite exciting task.
Thank you both for joining us today and for the very interesting discussion. And I hope to have you back here in the studio at some point in the future again. And to our listeners, I want to remind you that we have an email address where you can reach us with any questions or suggestions for topics for future episodes. And the email address is nextgenfin@seb.se, and that's nextgen, Fin, Fin, @seb.se. But for now, goodbye and talk to you later.